Recessions will make you rich. Not only that, but they are something that you should be looking forward to. So why is everyone afraid of recessions? Why shouldn't you be afraid of recessions? And how can recessions make you rich? When there is a recession, many novice investors freeze with fear. It's the same kind of primal fear ancient people felt during an eclipse. In modern times, schools teach how eclipses work, and that knowledge helps us not to panic. Schools don't teach personal finance, which is genuinely disgusting. I've learned about the presidency of James Polk, read Shakespeare, learned how to calculate the volume of a sphere. I've used none of this knowledge since graduating. As for my personal finance knowledge, I've used it every single day, just like everyone else. Since schools have failed their students, people learn about personal finance from their parents and media. Many parents have recession horror stories to share. The story could be about panic selling while the market is low, job loss, or both. These stories are treated as if they were acts of God, unavoidable and punishing. But the truth is, panic selling is a choice, and thereby is avoidable. As for job loss, an emergency fund can help mitigate the damage. At least your parents have good intentions. The attention economy creates perverse incentives when it comes to media teaching personal finance. CNBC, Bloomberg, and modern choices like TikTok, YouTube, and Instagram make money by having you watch ads. The more ads you watch, the more money these outlets make. When there is a recession, these outlets keep you captivated using fear. Who knows what scary event will happen today? If you look away even for a second, you could find yourself in financial ruin. Are you going to risk your future by clicking off the video? As you consume the doomsaying news, you are barraged with endless ads. You walk away full of fear and are likely to make rash financial decisions in the future. On the other hand, the media company made bank. Now let's address the elephant in the room. Why is all of this fear irrational? Why are your parents in the media wrong about recessions? Let's start with a fact. As an investor, you should be thinking about investing in terms of decades. You'll likely start investing in the stock market in your 20s and 30s and won't stop owning stocks for the rest of your life. That is 50 to 70 years in the stock market. The major events in the stock market today are just a tiny fraction of your overall journey. For example, the COVID-19 recession lasted 2 months. Yes, it was a wild 2 months. Unemployment jumped up over 14%. The stock market plummeted 30%. Tons of people were panicking, believing the world was ending. But it was just 2 months. That's less than 1% of your investing journey. To help you visualize what long-term investing looks like, let's set some expectations for what the next decade will likely bring. The first expectation you should have is that a recession will occur. The recession will likely be shorter than you're expecting. From World War II onwards, the average recession was just 10 months. Within the context of a decade, that's just not a lot of time. If that stat feels weird to you, it's not surprising. From World War II onwards, the shortest recession the United States had was COVID-19, which lasted 2 months. The longest recession was the 2008 recession, which lasted 18 months. The last 2 recessions you experienced were the extremes. Now, sometimes recessions do happen twice in a decade, but even if the decade had 2 recessions, each lasting a year apiece, 80% of the decade would be good times for the stock market. So when the inevitable recession does hit, how low does the stock market go? Well, you should be emotionally prepared for a 30 to 50% drop. Now, that is very intimidating, but the data shows that after the drop comes a period where the market comes roaring back. And that positive momentum lasts a lot longer than just a year. Now, if that 50% drop does scare you, remember that your investment portfolio doesn't just have to be stocks. Your investment portfolio can include defensive investments like bonds, which fare a lot better during a recession. Always make sure to cater your portfolio to your risk tolerance. The second expectation you should have over the course of a decade of investing is that the global stock market tends to go up. If the alternative was true, then no one would invest in the stock market. Now, it is important to remember that individual countries can take a long time to recover. For example, Japan took 30 years to recover from the real estate bubble in the 1990s. The United States took 13 years to recover from the dot-com boom because 2008 knocked the wind out of the United States right as it was almost recovered. This is why it is important to diversify, investing in companies all around the world instead of being dependent on only one country's companies. Now that you're armed with a long-term perspective, let's discuss how recessions will make you rich. When you go to a grocery store and you see milk on sale, do you get angry or scared? No, you celebrate. You probably stock up to save money. It's the smart thing to do. When the stock market is down, smart investors view it as a sale. It's a buying opportunity. It's buy one, get one free on all of your favorite companies. Black Friday is just one day a year, but when there's a recession, there are literally months of sales in a row. When the market comes roaring back in a year, think of how much money you're going to make. Now, it's important to understand the best strategy for taking advantage of the sale. As an investor, you don't know how long the recession will last, nor do you know how deep it will go. Even predicting a recession is a mind-blowing feat. Think back to the 2008 recession. The existence of a handful of investors who predicted 2008 was shocking enough for Hollywood to make a movie about it. When a recession occurs, you know that the market is on sale, but you do not know how good a sale the stock market will have, nor do you know when the sale will end. Therefore, the smart investing strategy is to keep buying the whole way through. The easiest way to do this is by increasing your 401k contribution or any other automated investment plan you have. You'll keep buying all the way down and will even be investing near the bottom at some point. Once the stock market is back to normal, just reduce your automatic investing plan back to normal. For example, when COVID-19 hit, I increased my 401k contributions well beyond 20%. To fund this, I cut back on my discretionary spending. As people sold in a panic at low prices, I was on the other end of the trade buying everything up. What was the result? The market has risen well over 50% since then, making me a lot of money. Now, I didn't know whether the United States or the rest of the world would recover first. Therefore, I literally bought everything. I invested in the Vanguard Total Stock Market ETF and the Vanguard Total International Stock ETF. VTI buys up the entire US stock market. VXUS buys up all the non-US stock. Both bounced back nicely as COVID-19 subsided. To maximize their buying opportunity, smart investors often have no debt besides a mortgage. This frees up cash flow since the investor has minimal obligations they need to pay. The more money you can invest while the market is on sale, the wealthier you will be long term. While you'll be investing in the market for 50 to 70 years, you'll only be making a salary for around 40 of them. That means you will only have 5 or so sales in the market while you're working. Take each one of these sales very seriously, because in retirement, there is very little you can do to take advantage of a stock market sale. Now, there are 2 reasons why someone might not be able to take advantage of the sale. The first reason is job loss. Truth be told, most people keep their job during a recession. Even during 2008, unemployment only hit around 10%. But given that you will be working through 5 or so recessions during your career, you might get unlucky during one of the recessions. If you lose your job, your goal is to play defense and not sell your investment portfolio at a low price. This is why having a 3 to 6 month emergency fund is important. You can live off your emergency fund while you search for more work. The alternative is pulling money out of your retirement account. Not only would you be selling low, but you'd also potentially run into taxes and an early withdrawal penalty of 10%. Investing isn't just about buying assets, but also having the ability to leave the assets untouched. The other reason you might not buy into a sale is because you're still afraid. If you are, that's okay. While there are best practices for investing, those best practices might not work for you. For example, we all know if we eat lots of vegetables, don't drink soda, or eat ice cream and work out, we will lose weight and get fit. That's the healthy thing to do. Now, how many of us actually do all of that? Finding success in life involves bending best practices to fit who you are as a person. If a recession still scares you and adding bonds to your portfolio doesn't alleviate your fear entirely, consider hiring a financial advisor. Paying for an advisor is a lot cheaper than panic selling during a recession and locking in 50% losses. In conclusion, recessions will make you rich, and I'm not crazy for speaking that truth. If you want to learn more, consider subscribing. It would help me out. Thank you.